Good morning and welcome to Charting the Markets on Tuesday, the 14th of March 2023. Now, the high volatility of late is slightly abating today because we are expecting US consumer price inflation to be published later today at 12:30 p.m. Don't forget the US markets have changed their clocks just this weekend. And basically, US CPI for February is expected to come in between 6% and 6.2% on a year-on-year basis. And that compares to a January reading of 6.4%. On a month-on-month basis, we expect 0.4% to be seen versus 0.5% in January. And with regards to core CPI for February, we expect to see a rise to 5.6% year-on-year and a 0.4% month-on-month rise. And that is unchanged compared to the previous month. So this data will be looked at very closely by the Federal Reserve. And with regards to the Fed, it is interesting to note that the recent volatility we've seen with regards to equity markets in particular means that the financial markets have completely repriced the upcoming 22nd of March Fed meeting rate hike expectations, because basically we are now expecting by about 50% to see no rate hike on the 22nd of March, when just last week we were expecting a 50 basis point move with a 70% probability. Some investment banks are even expecting the Fed to pause its quantitative tightening. So there's a lot going on now with regards to the fallout of the collapse last week of Silicon Valley Bank, the US's 20th largest bank and the second biggest banking collapse in this century. And volatility will probably remain quite high over the next few days, as we saw overnight in Asia, for example. Banking stocks tanked quite brutally, and they followed their lead from European banking stocks, which fell off very sharply yesterday, pushing global equity indices lower, not just here in Europe, but also in the US. And that was despite the new Federal Reserve support program, which protects US depositors and their funds with SVB, and also despite reassuring comments from President Biden. But we also have the European Central Bank out on Thursday, and it'll be interesting to see whether the ECB will hike its rates by 25 basis points or 50 basis points, as was expected just last week, or whether it might even just not hike rates at its meeting on Thursday. So a lot going on with regards to the financial markets. And before we take a look at the equity indices, for example, I would also like to mention that the UK unemployment rate earlier today came in at 3.7%. Versus an estimate of 3.8%, and that the total pay gap and pay growth basically eased to 5.7% year on year. But in real terms, wages actually dropped in the UK by 3.2%. And that's the largest decline since 2009. So let's just have a look at the impact of this on the FTSE 100. And as we can see here on this daily financial bet, we have fallen very sharply. And those of you who followed my Charting the Markets sessions basically will know that I was quite worried about the FTSE potentially coming off. And I did say that if we were to fall through the previous reactive lows, we would very quickly slide down to the support area made up of the early and mid-January lows, between 7,708 and 7,724. But we not only just tested that support, but we fell right through it and did so with a huge decline yesterday. So in total, since the whole SVB debacle started, the FTSE has given back about 5%. And as you can see here, we are now forming a doji because the FTSE along with its peers, is awaiting today's CPI data out at 12:30 p.m. GMT time, not the usual 13:30 p.m. Just be aware of that. So where can we go from here? Well, basically, this sharp sell-off, what it has done is basically take the FTSE through key support. And for me, that means that we may actually be at the beginning of the resumption of last year's bear market. So we'll have to see that is whether that's the case or not. And remember, the FTSE was actually the one of the best performing major indices last year and hardly declined with regards to all its peers, which dropped by double-digit figures. So from a technical perspective, for me, as long as we stay below that previous support area now because of inverse polarity, a resistance area, i.e. as long as we stay below 7,724 on a daily closing basis, the upside is basically out of the water at the moment, and further downside is likely to be seen. So what are the downside targets? Well, we've got the red line here, the 200-day simple moving average on this daily financial bet, which comes in at 7,422. That would be the next downside target with regards to the FTSE 100, followed by the December low at 7,296. And a fall through there, in my opinion, would very likely lead us down again towards the October low at 6,705. So this sharp decline in the FTSE 100 cannot be taken lightly. And when we move on to the German markets, you can see here we have the October to March uptrend line, and we fell through this basically yesterday. Not only did we fall through it, we also closed below it, and we closed also below the last reaction low, the early March low at 15,145, and hit our downside target area between 14,992 and 14,904. And these are the lows from mid to late January. Now, interestingly enough, and this is why I love technical analysis, we have held at that support zone so far and are slightly bouncing back today. So it'll be interesting to see after today's CPI data whether the DAX can actually hold above this 14,904 low and also yesterday's low at 14,885, because as long as we do, this long-term or medium-term uptrend since October of last year remains intact. Having said that, if we were to fall through 14,904 on a daily closing basis and also this Friday on a weekly closing basis, then for me that would indicate that we have formed a top and that we will see a medium-term decline take us back down again towards the December lows and the 200-day simple moving average towards 13,813, 13,697. And for me, it would also indicate that we are resuming last year's bear market. So really important support at the moment that is being looked at, and we will see whether this support will hold or not with regards to US CPI data and also the European Central Bank out on Thursday of this week. Now, US markets, interestingly enough, did fall yesterday. They've also declined quite sharply, especially US banks. But yesterday's fall in the S&P 500, for example, and you can see here the daily financial bet, wasn't as great as the several-digit declines we saw, about 3-4% in several European indices yesterday, with the S&P 500 decline by less than 1%. And what has happened is basically we've bounced off this downtrend channel support line, and this is the February to March downtrend. And right now we're just holding again, wanting to see what the CPI data will bring later on. Because if consumer price inflation remains high, then that will put more pressure on the financial markets, and that could then lead to a decline, taking us back in the S&P 500 to the 3,764 low, the December low. Failure there, in my opinion, would pretty quickly lead to a decline, take us back down towards the October low at 3,491. So right now, things are not looking bullish for the S&P 500, but there is still hope because we've seen 5 waves to the downside so far with regards to Elliott waves. Perhaps we can see an ABC correction to the upside, and that might then be followed by further downside, which is quite likely. But if the corrective move higher, which may happen, takes us back above the red line here, the 200-day simply moving average at 3,933, and then more importantly, back above the breached uptrend line and also the early March high at 4,078, then that basically means that the uptrend from October is still intact. But right now, things are not looking that bullish and are actually rather bearish. Now, the collapse of the Silicon Valley Bank basically led to a lot of volatility, not just in equity markets, but also with regards to the US dollar, as the financial market participants repriced the Fed's likely decision with regards to hiking its rates. And most market participants now expecting either no rate hike to be seen at the 22nd of March meeting, or a 25 basis point rate hike. Whereas the odds of this happening last week was a 70% chance of a 50 basis point rate hike being seen. So all of this has had an impact on the US dollar basket. And as you can see here, we have had 3 consecutive days of lower prices with regards to the US dollar basket. And you can see here the drop we've seen was by around 2% so far. But interestingly enough, and this is why, again, I like technical analysis, we held at this support area, which I've been showing you for the last few weeks. And that basically is made up of the December lows. And as long as 103.08 holds here, for me, we could still see this decline as a corrective move with further medium to longer term upside to be seen in the US dollar. Having said all that, because we formed a higher high and then a lower high on the relative strength index here, the RSI, when we made our 105.51 high in early March, that was telling us that there was negative divergence in the chart, and it was forewarning us of a possible trend reversal or at least a consolidation phase being seen. And this is now taking shape, and we'll have to see whether today's CPI data will help the US dollar again to then bounce off the support area or not. If it does, we could have as a short-term upside target the mid-February high at 104.36 in place, and also 105 area could be targeted. But basically, as long as we remain below 105.51, the downside really is probably the preferred trade on this daily financial bet. And if we were to fall through 103.05, which was yesterday's low, then the 102.18 low would be in focus. Failure there would probably take us back down again towards the February low 101.57. So again, very interesting to look at the US dollar basket. And with the euro making up 57.6% of the US dollar basket, you can see the inverse here. We've had 3 consecutive days of higher prices with regards to euro dollar, taking us through the February to March downtrend line, and also, excuse me, above the early March high here at 106.94. This is positive with regards to the trend. It means we formed at least a minor bottom, and it's likely that we're going to see further upside, depending obviously on today's CPI reading out of the US at 12:30 p.m. If we were to rise above 108.04, that's the high from mid-February, then for me that means that the support area here I've left on the chart has held, and that further upside is likely to be seen with regards to euro dollar, taking us back up towards the psychological 110 area. If we were to come back off again, we would have to see a slide not just through 105.25, last week's low, but also toward to below this key support area between 104.84 and 104.44 for further downside to take us to the 200-day simple moving average. But right now, euro dollar does look short-term bullish. Euro sterling is also interesting because, as you can see here, we've just been trading in a sideways trading range in this triangle formation, and the breakout of the triangle has to happen pretty soon, because it has to happen basically within 2/3 of the whole length, so before the end of this apex of this triangle. And if it were to happen to the downside, most likely we would then get and fall through the 87.22 January low and fall towards the 200-day simple moving average at 86.80. If, however, we were to break above the 82.25 to 28 area, the mid-February and current March highs, then the breakout would likely take place to the upside. So interesting there again from a technical perspective. Commodity markets have also been very much impacted by the volatility in US dollar and also by its slide in the last few days. And obviously some commodities such as gold, for example, have had flight to safety flows into the precious metal out of equity markets, which has pushed the price of gold higher. But before we talk about gold, I'd like to quickly mention the price of Brent crude oil. And as we can see here, Brent crude oil has been trading in a sideways trading range since mid-November of last year, but is now slipping, and it has fallen through the late February low at $80.30, and yesterday dipped down to $78.08, and that was a low last seen since the early January lows. And here, basically, as long as we remain below the 9th of March high at $83.81, for me the downtrend is very much intact, and should take us down again towards the December low at $75.32, and perhaps even much lower towards the $70 mark or so. So here again, short-term downside to be seen on worries to do with the financial markets and risks of sentiment being seen globally. Now, the beneficiary of this risk-off sentiment has been the price of gold, because gold, as you know, acts as a safe haven metal, and it tends to rise when there is a lot of uncertainty in financial markets, and this is exactly what has happened here. And we've seen a surge higher in the price of gold by around 9%, I believe, in the last 4 days. Oh no, by about 5%, so it's good that I double-checked this. And that took us to yesterday's high at $1,914 per troy ounce. If we were to rise above that today on the back of CPI data, we could then potentially extend this rally to the highs seen in early February at $1,959. But in that case, I believe we would also most likely head towards the psychological $2,000 mark. If we were to stall here and come off again, we've got pretty good support here around the previous early March high, around $1,858. But given the strong advance we've seen recently, the odds are, even if short terms we're seeing a reversal, unless this reversal is a large reversal, that further upside might still be in store in the days and weeks ahead. Now, silver is kind of interesting because the price of silver has bottomed out, has come out of this downtrend channel we've had in place since the beginning of February, and silver has actually risen by more than gold, and did so by nearly 9%. Compared to gold's 5% so far. And here, what I would like to see for this bottoming formation to be confirmed is to see a rise above the 22nd of February high at $21.98, because then I think we could then head back again towards this range trading sideways equilibrium we saw in December and January around the $24 mark. So short term, again, a potential of a reversal being seen with regards to the price of silver. Now, I'd like to finish up on the price of copper, because here again, technical analysis has been extremely useful of late, in that we have slid down to marginally above this key support area I've been mentioning for the last few weeks, between the November and December highs, between $8,629 and $8,593 per ton, and have, as you can see here, bounced off that support area yesterday and formed this bullish hammer formation. Now, the hammer formation will only be valid if we were to rise today above yesterday's high at 8,949. If so, then we would likely retest the downtrend line at around 9,016 and perhaps head back up again towards the 9,219 highs seen at the end of February. But we really need to take out the hammer high for this pattern to become valid. As long as it isn't taken out, further sideways trading above this key support area is likely to be seen in the days ahead. Thank you very much for watching Charting the Markets with me today, and feel free to follow me on Twitter if you so wish. My Twitter handle is @AxelR_IG.